Thanks, Alex, and thanks for putting on a brilliant show as always. I'm Mikael. Thanks everyone for joining in. I'm a co-founder and general partner at Ox, which is a specialist VC firm looking to back Europe's most promising B2B SaaS companies at the scale-up stage. I've spent more than 20 years as an investor in fast-growing tech. Majority of that has been dedicated to B2B SaaS. I've had the fortune to be part of some very successful companies going all the way to IPO and trade sale exits, and I've also had my fair share of failures. So today I'm going to try to distill some of the key learnings from those positive and negative experience and hopefully help you a little bit in terms of how to think about how to build a really large company and what your priorities should be at different stages of that journey. Most of you listening are probably building towards the first handful of $1 million of ARR. I'm going to be focused on what happens next and what you can do already today to increase your chances of building a really large company that scales into the hundreds of millions of dollars of ARR. Okay, so let's jump in. Let's to set the scene, let's consider three SaaS companies that start their life at the same point in time. For simplicity, let's just assume they all have great tech, a large TAM, and a strong founding team with relevant background expertise to solve a major problem. Essentially, this is to say they start their lives in a level playing field, and for the first couple of years, their development is relatively similar. After a few years, however, company A starts to lag companies B and C in terms of growth. Company A struggles to add new customers and to retain their existing customers. There probably isn't much growth within that existing customer base either. Their initial growth stagnates fast, and relatively soon, a fight for survival kicks in. A fight that is often protracted, but inevitably leads to demise. The best case outcome here is typically an acquire where there is a company that needs the talent that's in this company, but not the product. And needless to say, this scenario is rarely a successful financial outcome for neither founders or investors. Moving on towards the right of our chart, we can see that companies B and C remain on fairly similar growth trajectory for another few years. Both companies can look relatively successful and promising for the first 5 years or so. But just as company C takes off, company B stagnates, and their respective growth trajectories diverge dramatically from there on. Whereas company B struggles to scale customer acquisition in an efficient way, company C accelerates customer intake and sports killer metrics. Company B may have a group of loyal customers that keep buying to support growth for another few years, but eventually the lack of new customer acquisition takes its toll. Churn starts to creep up as well, making life more difficult for the Bs. Company C, meanwhile, thrives off superb net revenue retention, which in combination with strong new customer acquisition propels growth even further. After a period of unsuccessfully trying to boost growth, the B companies usually reduce their market and product related investments to steer towards profitability or sell to an opportunistic industrial or PE consolidator. And outcomes here can obviously be acceptable for both founders, team, and investors, but this is rarely the outcome anyone was hoping for in the early days when Company B was competing with Company C for fame, fortune, talent, and investment. So the obvious question then is, how can we become a C-style company? Well, in charting the evolution of companies A, B, and C, it's helpful to think about the SaaS growth journey in three different phases: product market fit, go-to-market fit, and growth. This is a model that many of you may have already seen, which is crafted by Mark Roberge, and it's a really helpful tool in focusing on the relevant priorities at different stages of development maturity. Having product market fit means you've proven there's a sufficiently large and attractive market for your product, that you have an initial and loyal customer base who are really hooked on your product, and above all, in SaaS, it means you have strong metrics around customer and net revenue retention. In my previous illustration, it is clear that Company A never was able to fulfill these criteria for product market fit. Moving up and towards the right, proven go-to-market fit in its turn means you have established a strong market position, but probably in a relatively limited niche, with healthy and steadily improving metrics around customer acquisition as well as retention. It's ultimately about proving that you can find customers, you can reach them, you can sell to them and onboard them and so on. And you can do so all in an economically rational manner that provides strong return on investment. It also means you built the core team for taking your company on an extended growth journey that may last many years and reach several hundreds of millions of dollars of ARR. That's not to say that the team is 100% complete, nor that you won't need to replace anyone down the road, but you are no longer a team of old founders. Based on its growth struggles in the previous slide, Company B did manage to hit product market fit, but they were never able to truly hit go-to-market fit. Finally, towards the right, grading to the growth phase requires you to prove your ability to grow fast at scale with strong and stable metrics. Companies that reach that stage, they often grow to become category leaders And whether they are acquired or IPO, they usually deliver life-changing financial returns for their founders, management, and investors alike. Company C is squarely in this category. So in the three-stage model, go-to-market fit sits in the middle as the bridge between product market fit and growth. The one major mistake that I and we as a firm see time and time again is companies trying to scale their marketing and sales efforts by brute force too early in their commercial development. They try to move from a position of having achieved product market fit directly to the growth phase by throwing money at the problem without first securing the sound go-to-market fit foundations. This is a proposition that very rarely succeeds. What it leads to is typically poor decisions, wasted money, missed opportunities, and unnecessary dilution for founders. Don't get me wrong, for every successful SaaS company, there definitely comes a time to step on the gas and invest aggressively. But if you do so without first establishing the proper foundation, that is a really hard sell. And sure, every now and then a company comes along that just flies out of the gates and grows exponentially for an extended period of time without any challenges whatsoever on the go-to-market side. And if you run one of those companies, that's great. Congratulations. We'll see you at the IPO bell ringing. If you don't, and the data is unfortunately pretty clear that most of you will not, more than 99% indeed, then my message is this: it's still possible to build an incredible company if you focus on the core fundamentals and optimize for the right growth lever at each stage of the journey. So let's move on now to some of the practices that we recommend to maximize your chances of becoming one of those breakout companies. And the first one of those is to start with a really deep dive into how you're positioning your company and product. Essentially, this means deciding where you compete and how you're going to win in a competitive global market. It's as much, if not more, about what not to do as about what to do. A lack of great and deliberate positioning is probably the number one shortcoming that we see across all companies that we meet. It really is baffling that companies don't spend more time on this since it's so fundamental to everything else. And some of you may have already listened into April Dunford here, and you have some amazing speakers, including her. So she is obviously a positioning expert and authority. So I'm not going to get into too much detail about how to do positioning right. You're much better off listening to April about that. But I will address some of the issues in not having nailed you down for your positioning properly. The first is a lack of differentiation versus competitive alternatives. People essentially perceive you as similar or like for like to other alternatives, and you haven't made the necessary trade-offs to create clarity about who you're for, who you're not for, how you're different, and what are the compelling reasons for someone to choose you over company X, Y, or Z. Effective positioning is not a feature contest. That is a mistake made by a lot of companies. There are a million different ways to position your offering beyond feature depth and breadth. And that includes the customer focus you have in terms of size, use case, vertical geography, could be performance driven or about flexibility, could be driven by price, customer engagement, technology ecosystem, and this just goes on as long as your imagination, but please don't make it about the feature contest. Other issues with poor positioning is that you typically lack strong understanding of your customer's ROI and an inability to articulate that. And the final one is a proliferation of buyer personas and stakeholder. With a weak positioning comes confusing and ineffective messaging, which doesn't help the customer buyer journey. And if you find that there are too many individual stakeholders on the customer side you have to convince in order to get a deal done, you're well advised to look closer at how you're positioning your product in the first place. And moving on to the next recommendation, this can often be summarized as too much too soon. It's exciting to be running a fast-growing company and opportunities keep appearing from everywhere. However, if you chase too many things, you'll end up doing nothing properly. And that means you haven't built the foundations for achieving real scale. There's a handful of variations on this theme. The first one is a tendency to move on to the next thing before fully mastering and executing what you already works. This could involve an expansion of target verticals or a move towards enterprise if you're in the mid-market, or etc. We see companies expanding very early beyond 1 to 2 core use cases for the product, which drives a proliferation of buyer personas and sales process complexities. With few exceptions, it is better to double down on what is already working and truly master something before moving on to the next thing. Stay focused and don't spread your efforts too thin across a range of initiatives. Another common mistake is not to give sufficient time and attention to your existing customers. If the core focus in the product market fit phase is to achieve strong customer and revenue retention, this is still key as you focus on building for go-to-market fit. Stay close to your customers, invite the most forward-thinking ones to a customer advisory board, make sure to create case studies around the best customer use cases, and invest in customer success and account management. Every now and then, an opportunity presents itself, which at a quick glance could be transformative for your business. This might come in the shape of a really large and prestigious customer wanting to buy your product, or a great strategic partner wanting to OEM you. These shiny objects, as we call them, can be incredibly tempting, but unless they allow you to stay in the middle of the fairway in terms of how to execute your strategy, they need to be avoided at all costs. There are just too many stories out there how an all-important large customer partner completely steers a company off course, whether that be by forcing a change in the product or the go-to-market. Finally, every company needs to diversify its go-to-market initiatives and strategies as you scale. The way to do that is not to rebalance 50 or 60% of your demand generation budget on something new and untested. You should run a large number of controlled experiments to gradually change the mix over time. A good way to think about that is probably to reserve something like 80 to 90% of the budget to double down what is already working, and 10-20% on experiments. As these successful experiments scale, they'll move on to the proven category and leave room for new experiments. As you grow towards go-to-market fit, you will need to scale your senior management team to acquire competencies and experience that are missing in the founding team. First, and I will come back to the importance of culture, you should use cultural fit as a gating criteria in your hiring. It is really easy to be impressed by some CV and accomplishments, but unless they share the same fundamental views as determined by your culture, they're never going to work. There are a million nuances to this, but note that I'm not telling you to go any specific way in terms of how to build your right culture. I'm saying that regardless of what your cornerstones and pillars of culture are, make sure to hire people that are attuned to those, no matter how good they are at their profession. You also want to hire people who are stage appropriate. Very common pitfall among many companies. A VP sales who's going to run a large series of go-to-market experiments to help you reach go-to-market fit does not need the same qualifications ability as a CRO scaling a go-to-market organization from tens of people into the 50s and hundreds. Similarly, a VP finance who helps you build a 3 to 5 people team, you can get your metrics in place, is different to a fully fledged CFO who can take you public and manage a public investors. There are other fit considerations as well, but in the interest of time, I'll move on to the importance of scaling a leadership team and striking the balance between individuals who have experience from running their function in a company at your stage and size with step-up candidates. It's not either or, it's both, but make sure you don't tilt too heavily in either direction. A final word then on building the senior team: do your due diligence. Too many people trust indirect sources, and particularly headhunters. Don't do that. Make sure that you get the first-hand information. And finally, overinvesting culture. This is a common problem we see time and time again, where companies simply don't acknowledge the importance of culture and hiring for culture fit. We see too many companies doing this, and it becomes a major drag on their forward potential. The reason culture is so important is that it sets the platform for everything else. If you have a strong culture, it guides you how to collectively behave as an organization, what customers and partners can expect from you, and what employees can expect from leadership and from each other. It helps prospective employees understand if they're a good fit, and help you understand whether they're a good fit as well. All of this is another way of saying the culture scales, whereas the processes and policies you establish to optimize the business usually don't. They break at certain points and need to be updated. When you're running at very fast speed, it's hard to keep processes and policies up to date. And then culture becomes the guiding light for everyone in your organization. This is difficult to quantify, and you'll struggle to calculate the ROI on culture-related investment. Therefore, anything you do here needs to be conviction-driven. But there are some helpful metrics that, while not causal, are closely correlated with a strong culture. That would be things like employee retention, customer, and employee net promoter score. And with that, I think I've raced through everything, and that was all I had today. So thanks everyone for listening, and over to you again, Alex.
Thanks so much, Mikael. Great stuff, great presentation. Really appreciate it. Always learning. And Sasha's put in the chat, if anyone's got any questions, drop them there and they'll be answered. So once again, thanks, Mikael Johnsson, General Partner at Ox Ventures. Really appreciate it, and great content.
Thanks, Alex.